So let's start. What are you going to be learning today? What are the goals of this session? Well, first of all, you're going to learn how the financial system is designed. What we aim to do at Economic Street is to impart to you principles. We very much believe in a principles-based approach, because when you understand how something works in principle, then you can know how to react to it or anticipate a change in the system. So that's going to be one of the key aims of this session today. The next one is you're going to learn how to take advantage of this financial system, because there are ways to actually take advantage of it. And we're going to do this by showing you and taking you through different scenarios that will help to stimulate your understanding and to get you to really imbibe the learning objectives of today. And finally, you're going to become more confident in making sound financial decisions from attending this webinar today. So let's begin. The financial system, there are three key terms that you will always have to know when it comes to understanding how the economy works in this country, but even globally. And it's these three terms. The first one is credit. Credit is your ability to borrow money and pay it back at a later date. It's very simple, but it's actually a very powerful word. Most money in the world is actually credit. About 95% of money, in fact, is credit. And that means you're always going to encounter it at one stage in your life. So that could be your tuition fee, your student loans at university, your credit card, your mortgage, and even your car finance, your personal loan. It actually impacts your life to such a degree that you need to understand how, not only why it exists, but how it flows. So that's the first one. The second word is inflation. And inflation simply means that the price of things are rising with time. So that means it will take you more money to buy the same amount of stuff. Good way to quickly think about this is to imagine how you used to go into your local newsagent. 50p before could get you a can of drink. Now it's about 80p to a pound. That is simply inflation working. That means it's taking you more money to get the same amount of stuff. And that means you're getting less bang for your buck. And final term is interest rate. So this is the money that you earn or you pay, depending on whether you've saved money or borrowed money. These three work in tandem with each other to form the financial system. So when one is affected, the amount of credit can be affected through these other two. And Nick is going to go into more detail now, just to really break it down for you, to make sure you understand how it works in principle. So before I hand over to him, just to reiterate, it's 95% of money is credit. Credit is simply when you go to a bank and borrow money, and it works on just good faith. It's literally just that. It's on the premise that you'll be able to pay this back in future at the time decided with the interest that they charge. You can actually do this between yourself, between you and your friend, in theory, because there's literally credit. There's nothing. There is nothing that credit is has been designed to be backed up by. So it's literally a bank just creating a credit in your account and saying you've got this money all of a sudden. And it comes out of thin air. This is going to be the hardest thing to probably understand and to get your head around, because there's actually no other way around it. It does come out of thin air. So 95% of the money that you're seeing is not backed by gold. It's not backed by anything. It's literally backed by the good faith of people interacting with banks to say that, or to enter into transactions, to say that one person is going to lend to the other and they agree to pay it back at a future point in time. So over to you, Nick.
No problem. Thanks for that, Ola. Just a quick one, actually, is slightly off topic, but that essentially is kind of why the financial crisis of 2008, 2009 happened. Because money is effectively credit, when banks went to then knock on other banks' doors to say, where's my money? Effectively, there was no money. And that's what led to bank failure. But that's something that we'll discuss further at another time. But just to put it into perspective, so yes, credit is essentially a cycle. So say one man's spending, or one man's debt is another man's spending. So let's put it into perspective. So let's start with income. You've just got a new job, so you've got an income coming in. The bank now see you as being creditworthy because you're now receiving this income into yourself. So for being creditworthy, they would then lend you some money. So it's technically you're now borrowing, you're enhancing your credit. You then go and spend. So say Ola is a car manufacturer. You then go and spend to buy a new car at Ola's factory. By you spending, you're creating income for Ola. So now Ola's got this income from you purchasing his vehicle. He then is seen as more creditworthy to the bank. So he himself can now go to the bank, and because the bank see him as creditworthy, they then lend him some money. And this cycle continues. So essentially, through someone else from the bank initially lending credit, people can then keep spending essentially. But that spending, as we've seen by the financial crisis, is not a good thing. And then this is where, if you just go to the next slide for me, please, Ola. This is where three key components, which Ola said at the beginning, come into play. So this credit that we discussed on the previous slide has caused inflation. Why has that caused inflation? It's because if everyone is spending in the economy, creating demand, when you have more demand, what does that usually cause? Prices to go up. Because if everyone's demanding a certain good, I want to sell to the high. If everyone wants my car, I want to sell to whoever wants to pay the most. So what will happen essentially is that car was originally, say, worth £1,000. That is now worth £2,000. So it's caused inflation in the economy. Another way you may get inflation in the economy is, say, through news. So a prime example of this would have been when Brexit was announced. When Brexit was announced, the value of the pound dramatically fell against most currencies, but in particular the US dollar. So what happened is, because the value of the currency fell, this in turn made us importing goods from Europe, from the US, more expensive. So because this is now more expensive to purchase goods from abroad, this is also a cause of inflation. So how can this inflation be controlled, and how does it tie into the slide? You have interest rates. So interest rates are set by the Bank of England. So the Bank of England are the central bank for the UK. So they are, one of their jobs is to provide price stability in the economy. And by price stability, that means keeping control of inflation. So what did the Bank of England do in times of rising inflation? Well, when they see inflation rising, they then raise the interest rate. And the interest rate is the base rate in the UK economy. So the interest rate is the rate that other banks, when I mean other banks, that's your commercial banks, so your HSBC, your NatWest, your RBS, that's the rate that they borrow from the Bank of England. So when they set the base rate, this is filtered through into the banking system, and then the commercial banks themselves will then raise their interest rates. So what does that mean for you if the interest rates are being raised? So if you was borrowing, so you've gone and got all this credit, you've been borrowing from the bank, it's now more expensive for you to borrow that money, because now you have to pay a higher interest back to the bank. So what does that in turn do? That then means that you will then have to spend less because you have less disposable income, because you have to pay back more money to the bank. So what this is then doing, this is then cooling down the economy, because people are spending less. When people are spending less, prices tend to fall. But another reason why this helps cool down the economy is because if interest rates are going up, you can earn more on your savings. So instead of spending money, you're more likely to put your money into bank accounts and earn an interest. And by earning this interest, you then also are not spending in the economy. But then how does this revert back to credit? So this is all one cycle. So now the economy's starting to cool, and you see that what may now happen is, as the economy is cooling, people have paid off their debts, etc. The bank of it, and also inflation has now fallen due to the interest rate rise. What will now happen is people will feel that the Bank of England will then start to lower interest rates, and by lowering the interest rates, people may feel that now they're more creditworthy again. So then they will go and borrow from the banks, and the whole cycle starts again. I'm saying it can be a little bit more complicated than this, but the nuts and bolts of the economy is literally these 3 steps. I'm saying there is a little bit more that you can get a bit more technical about, but in a nutshell, if you can understand these 3 key components between credit, inflation, and interest rates, and the figures that you're seeing in the news, and incorporate this and start to understand it, you can then start to get a bigger picture of the economy. So we have a few questions that Ola's going to go through now.
Cool. So thank you. Just to reiterate, so for example, Demi and Aaron, let's take you guys, for example, just to break this down and look at it from a practical point of view. Demi, let's imagine that you have a job. It pays you £30,000 a year. You're ready to buy your first house. You walk into the bank. They lend you because they see you're earning £30,000. And then you go and spend it. You go and spend it with Aaron, who's a house builder. Aaron now gets a bit of money because you've got that mortgage. That's income for him. Because he's now got, let's assume that your mortgage is £300,000. Aaron just has £300,000 to go spend. But because he also has £300,000, he's more creditworthy. The banks will lend him more money, which means, let's say he wants to buy a house for 1 million, he will be able to do that. And this is literally how credit grows. Demi, you've got a mortgage now for £300,000. Aaron, you've got one for 1 million. That is 1.3 million in credit in the system. So, but let's assume that this keeps growing and everybody keeps getting more credit. That means house prices are going to start going up, isn't it? Because if we only have, let's say we only have one house in this example, to be able to buy that house, you guys are going to outbid each other. And so the prices keeps rising for this property. If this gets out of control, this is where the government steps in to say, hang on a minute, there's too much, people are spending too much, too loosely. So let's raise interest rates. What's that going to do? It's going to make your mortgage more expensive. It's going to make it more expensive to also take out new loans because you're paying more in interest, and it's going to put you off. Also, at the same time, you guys are earning income. If you want to invest and save, you're going to earn more money on that. So these 2 issues are playing off each other. And that's when you start getting less credit in the system. So that's how the cycle works. So every time you see, for example, in the news, the BBC will always say every month what the inflation rate is. At the moment, it's about 2.5%. Before it was 3%. That meant the price of stuff is rising by 3% each year. So, you know, an apple that was £1 is now £1 3p. If the price keeps going up too fast, and Demi, coming back to you, let's say you're still on £30,000, but now everything that you need to buy every day has gone up in price. You're going to be worse off, aren't you? So that's when the government can then take a look and say, hold on a minute, can Demi actually afford to live every day, given the fact that things keep going up in price? If not, what can we do to fix it? And that's when they now move to interest rates and say, can we do something about this? If we put up interest rates, hopefully that will bring down the price of stuff because people will be spending less. The price will start falling in shops, and therefore Demi will be more comfortable. Does that make sense now? Please send in your questions. We'll be happy to address them. And yeah, we'll go from there. So to really know this, so we're going to go through a couple of scenarios. So this is where you guys are going to need pen and paper. We're going to give you a few questions. Think about it. Let's talk about it. So in this scenario, Nick has already explained what the Bank of England is and what they do. So they look after essentially the economy in the UK. And most countries around the world actually have their own central bank as well. So in this scenario, the Bank of England say they're raising the interest rate from 1% to 2%. How does this affect you, Demi and Aaron, if we were to go to the bank to borrow money? What do you guys think?
We've had a few thoughts in the chat, Ola.
Okay.
I believe Aaron has responded by stating that his mortgage rate could potentially go up, or indeed loans, and bank interest rates could increase as well.
Nice. How about you, Demi? How's this going to affect you? Any idea? That's cool. We'll move on to the next one. How about if you were a saver? How's your answer going to change?
So hopefully, bank interest rates increase. I think it will slightly affect bond prices as well. So yeah, those are probably two main things I can think of.
Yeah, that is true, and I like.
And bond prices.
Oh, sorry to interrupt you.
Sorry, no, go on.
No, go ahead. No, finish your answer. I didn't mean to interrupt you.
No, yeah, that's what I'm saying. That's all I can think of at the moment.
No, but that's something I like that you've started to think out of the box as well. There's stuff that we'll be looking at in future week when you talk about bonds, because yeah, you're correct. Bonds are heavily affected by interest rates as well.
Yeah.
So you're already starting to think outside of the box in terms of interest rates doesn't just affect your mortgages or your credit. There's other financial products that interest rates also affect. So I like that you're already thinking outside of the box.
Yeah, because it'll affect the way, obviously, central governments can borrow and how much they can borrow and blah blah blah. So,
yeah, that's correct.
Nice. Cool. Next question. What happens to the amount of credit now in the system if interest rates go up?
Less credit available, I want to say.
Sorry, say that again. Say a bit louder.
I say less credit. I don't know if it's less credit available, but it's been more expensive to take out credit.
That's an interesting answer, actually.
I don't know whether the credit is available. I've never thought of it that way. I've just thought of it in terms of my cost of interest or my cost of capital is going up. Interest rates.
No, you hit it nail on the head. So there is less credit in the system. I guess in terms of capital, because it's more expensive now to service your assets. Or are they assets in a sense? Because a house is an asset on one side, but it's also a liability. Because you're still.
I mean, yeah, exactly. I mean, if you think about it from the bank's point of view, they're going to be assessing almost your credit worthiness at that moment in time. So if the interest rates have increased, potentially they're going to be a bit more stringent on thinking whether you will have the propensity to repay and not default. So that will restrict. Yeah.
Cool. Next question. What happens to inflation?
Inflation will go down.
Yeah, it usually does.
Yeah. Right. Yeah.
You're right. inflation will
Yeah.
go down because of the fact that people are not spending as much money because of the
Yeah.
fact that it's too expensive to borrow. And remember, we've already said that 95% of money is credit. So if it's too expensive to get credit, naturally, you spend less. And if you spend less, shops, businesses have to adjust their price to try and get rid of their stock,
Yeah.
which usually means that they start doing discount sales
Yeah.
and closing down sales like we always see. So yeah, inflation will start falling, and hopefully that should mean a reduction in the price of things in shops, which is good, especially for people that haven't got a pay rise in ages.
Yes.
Nice one. Next question. What happens? So this is a bit of a curveball to start getting you to think about what's going to come up in the next few sessions. What happens to the price of government bonds?
I always forget this one. Price of government bonds, interest rates go increase. I'm sure the price of government bonds go down.
Yeah, that's correct.
That's very true.
It's this inverse relationship
That's
between
it, yeah.
interest rates and the prices of government bonds. As you said, when interest rates go up, interest rates? Yeah, when interest rates go up, the price of bonds fall. That's because you're normally paying, or normally you'll pay a higher interest rate to service that bond then. So then people then will alternatively decide not to buy that bond, which then in turn makes the price fall.
Right.
So the way I like to
Again,
think
actually, one
about.
time, yeah.
Sorry, carry on.
No, because you explain that one more time.
Yeah,
Yeah. So the way I like to think about it is this way: if interest is going to rise,
yeah,
from 1% to 2%, I was attending my video. What you need to think about is the fact that a government is going to be borrowing more in the future, and it's going to become more expensive for them.
right, yeah.
So because it's going to become more expensive for them, it means that the bonds that they issue are going to have better interest on them.
Yes.
So so that means the current bonds in circulation are not as attractive anymore to investors because of the fact that they're not going to be paying as much interest as future bonds.
Mm-hmm.
So that's why their price starts falling, to take account of this, because people start moving their money out to buy the new bonds that are going to be issued with higher interest.
Right. Gotcha.
Yeah. Fine. Next question. What happens to the stock market when interest rates rise?
That's an unfair question.
Okay, let's back it up. I'll let you think about that one, because Demi just asked, what is a government bond? Very good question, Demi. A bond is simply an IOU. Imagine now if you want to borrow money from your mom. Now, I know usually she'll just probably give it to you, knowing what moms are like. But in a professional sense, what would have to happen is that you guys will have to write a contract between each other to say, Demi promises to pay back this £100, maybe in 3 months with interest. Now, literally, this is what a government does. They will issue this IOU and sell it to people like you and me, but also companies like your pension fund or your car insurance company, because governments also they need money to run. A government has to look after its old people. It needs to look after the NHS. It needs to fix railroads, or railways, roads, build new airports, new infrastructure. So a government themselves borrow money, just like you and me. And the way they do this is through what is called bond. So you can actually bonds, and you can actually invest in this because it will pay you an interest.
Cool, thanks for the question, Demi. So the final one was that Ola asked was, what happens to the stock market? So that's a very interesting question in terms of what happens to the stock market, because the stock market is made up of many stocks.
Yeah.
But generally, though, the stock market tends to fall
Okay.
because of you see safer investments, because stocks are known to be a little bit more risky asset than, say, a government bond.
Mm.
So what will happen is companies or firms or the everyday consumer would then tend to invest in the bonds that are paying the higher interest rates because they are seen as more attractive. And not only are they more attractive, they're also less risky. So that's not always the case, as in, but generally, as in, the stock market tends to fall as interest rates are increased. I don't know if you want to add anything to that, Olo or Jay.
No, yeah, go.
Do you want to go, Jay?
Go for it. I'll feed off the tail end if need be.
Okay, cool. Yeah, so it's a little bit related to the explanation that we gave you, Aaron, for why price of government bonds fall and what Nick just said. Literally because if you can get a better deal investing in a government bond, which is typically known as less risky because it's a government that you're investing in rather than a company, why would you then want to invest in a company? So that's why typically the stock market falls, because investors start to think, actually, I'm better off buying more government bonds, taking on less risk, and still getting the same return or similar return. And that's where you tend to get stock market falling. Does that make sense?
Yeah, makes sense.
How about you, Daniel?
Just to add on to that, sorry, quickly, within that process, I guess you also have another cycle within the different asset classes. So, as Ola and Nick has mentioned, stock market is going to fall, and then the attention then goes on to bonds, and then as the cycle continues, people will potentially move out of bonds and then find a what's considered to be at the time a safer place, which would likely to be cash holdings, and then the cycle then will continue. After cash holdings no longer is considered to be adequate, people then move back into the stock market, and then it will continually go through that, depending on whatever political or other economic factors are taking place within a particular region or country.
What about commodities, so like gold? I know like when certain things happen in the stock market, people tend to pull their money out and go to more safe investments like commodities, like gold, for example, silver.
Yeah, that's true, because gold is still seen as a relative safe haven. So gold is still, when the economy is in difficult times, people do still tend to purchase or hold gold as another asset, because it's known as the old term they used to use is the gold standard, which doesn't apply so much nowadays, but people still do see gold as a safe haven. Other sort of commodities, silver, yes, but to a lesser extent, and like oil and natural gas is not really so. It's still mainly the precious metal gold that's still seen as the real safe haven in terms of when the economy is in difficult times.
Yeah, and just to add on to that, I guess, because we've kind of advanced technologically and in terms of the different types of financial instruments and investment products that are available, a lot of the big players may not necessarily physically hold the commodity in terms of gold just because of logistics. So they might start to focus on trading a derivative of which gold is the kind of underlying or the focus of that investment.
Okay, cool. Let's slow it down a little bit. So Demi, everything that's just been talked about is going to be covered in future courses, but essentially the reason behind this is to start thinking what is happening to you every time something changes. So if, for example, the BBC announces that the Bank of England has put up the base rate, you need to think, how does this affect me? And what decisions can I start taking to better myself? So in this situation, it would be that, can you now do you have to start borrowing less because it's expensive? Or can you afford to save more to earn more money? And would it not be cheaper for you going into the stores to buy what you need, like your food? And also then when you get ready to invest, how do you change your investments? So that's the kind of thing that we want to get you guys to think about throughout this journey. We're going to look at a few more scenarios. Let's have a look at inflation now. Let's switch it. So this time, you hear on the news that inflation has gone up from 2% to 4%. And this is not actually far off what happened after Brexit. The first question to you guys is, what does this mean for you as an employee?
It means my Jamaican patty has now gone up from £1.50 to £1.55.
True. But
That's true stories, by the way.
But think of it in terms of wages. What's happening if this inflation happened?
So my purchasing power has gone down.
Yeah, so correct. So you're effectively taking a pay cut.
Exactly.
Because as I said, inflation's gone up, but your company hasn't, which we was seeing quite a lot over the last 18 months. Inflation's been going up, but wages have not been going up. So you're effectively taking a pay cut because, as you said, your purchasing power, what you can buy, you can now buy less patties effectively because patties are more expensive, but your wages haven't gone up to match the rise of the patty prices.
A good example of this, a quick one, is one which is the bane of a lot of people's lives, which is the travel costs. It's something that it's very difficult for you to avoid. You still need to get to work to earn money. However, every year that this tends to rise. So again, as this example demonstrates, your kind of purchasing power has reduced. So you're ultimately taking a pay cut every year. Your travel card goes up by £20-30, but your salaries remain the same and you haven't received any bonus. That's almost like you taking a pay cut each year.
Yeah. So yeah, Demi, just to put it in perspective for you, let's assume again that you're on £30,000 a year and you hear inflation has gone up. If you don't get a pay rise at work, like Jay said, that's basically a pay cut because now you're worse off when you go shopping because everything in the store has gone up in price, but your wage has not gone up to reflect this and to compensate you for being worse off. So that's essentially what it means for you as an employee. So this might be a good time to then start having those courageous conversations with your employer to say, excuse me, boss, can I have some more? More money. But yeah, that's what inflation means for you as an employee. Next question. What does it mean for you as a consumer? We've kind of already touched on this, but let's go over it again.
So that's just back to saying Aaron's patty example. As I said, the patties are now more expensive, so you can consume less patties because you need more money to be able to purchase the same amount of patties, essentially.
Yeah. That's it. What does it mean for you as a borrower if you're borrowing money from a bank?
Hopefully, my cost of borrowing should be cheaper. I think.
Yeah, you're on the right path. So essentially, imagine now you've got a mortgage, let's say £300,000 is your mortgage, and inflation has gone up. If the interest does not change on your mortgage, it basically means you're in effect paying back less money because
Exactly. Yeah.
the value of money is going down.
Exactly.
That's essentially what inflation does. Remember from the beginning of our examples, we said inflation is when you're getting less bang for your buck. So if inflation is going up, Demi, that means, and you've borrowed money for it to buy a car, that means it's not costing you as much to pay back that loan because money is becoming worth less over time.
Yep.
Any questions before we go on? Cool. How about this one? What does the government do in terms of interest rates if inflation is getting out of hand? Because remember, inflation is both a good and a bad thing. If it becomes too much, it means all your money is losing value, like Zimbabwe or Venezuela.
Increase interest rates.
Yep, that's it. So coming back to original cycle of credit, inflation, and interest rates. Remember, we said if inflation goes up, to solve it, you need to put interest rates up to get people to spend less money because it's becoming expensive to borrow money. And 95% of money is what? Credit. So if there's less credit and people are spending less, prices in shops start to fall. So this is the psychology of the system. It literally works on certain principles. And once you fully grasp and understand these principles, you can then start making decisions to protect yourself financially. Again, what happens to the stock market?
Goes up. Oh, sorry. Yeah, right.
Remember, government has just put up interest rates.
Oh, just put the interest rates. Goes down.
Yeah, usually. So again, when interest rates go up, people start thinking the stock market is too risky. Well, it's more risky than investing in something like bonds or cash. So they'll start investing, they'll take their money out of the stock market. And if everybody is rushing to sell, the price of the stock market, the price of companies and shares starts to fall. So again, this is how you can start to think, actually, what should I do with my portfolio when I'm investing? Should I sell? Should I hold? Should I buy more? And these are the kind of questions you ask yourself when you see things changing in the financial system. And we kind of covered this already. What happens to credit? This essentially just goes down, like we've said, because if the government raises interest rates, the Bank of England, to stop inflation from getting out of hand, then credit will fall because it becomes more expensive to borrow. Is this making sense so far?
Yep.
So what happens if we reverse the situation and inflation was instead falling? What happens to your answers in each of the questions before?
So obviously it will be the reverse for many of them. However, you don't want to get into negative inflation. That's what I would say. I think there's a risk of getting into negative inflation if inflation falls too low.
Yeah, you're on the right lines essentially. So when you've got falling prices, say deflation, as you mentioned, it's a bit of human psychology comes into play. because all the answers to all the previous scenarios is the opposite. But also, if prices are falling, us as consumers and the human nature will think, well, prices are going to continue to fall. I'm not going to buy that Xbox now because I know next week the prices are going to go down. So we then hold off on our spending. So even if the government or the Bank of England rather was to reduce the interest rates, which was essentially encourage us to spend, human nature would be like, well, why would I spend if I know the price is going to fall? And that's a situation that Japan found itself in with the deflation because of human psychology and thinking, well, it's going to be cheaper. People were actually holding off spending, and then the deflation was actually getting worse.
Yeah. Cool. So the most important thing out of all of this is always think there's three things at what play: credit, inflation, and interest rates. We've got that established. Below that is inflation is changing or interest rates are changing. If so, how is this affecting you on a daily basis? As number one, someone that is employed. Number two, someone that goes into the shops to buy everyday items. Number three, someone that needs to borrow money. Number four, someone that's saving and investing. So in those three spheres of your life, as a saver, as a borrower, as a worker, and as a consumer, you need to be thinking what is happening to you when inflation or interest rates are changing. And remember, they're feeding into each other. So that makes it a little bit easier to understand. So anytime you see this stuff mentioned on the news, don't shy away. Just immediately start thinking, actually, how's this going to affect me? And what can I do to protect myself or better myself from this situation? So we're going to have a quick fire round. This is for you to try. First question, what is the role of the Bank of England? Next question. You put £100 into an account. It pays you 3% in interest, but inflation is 2%. How much have you actually made on your savings? Next question. What happens to the amount of credit in the financial system if interest rates rise? Finally, if inflation rises and you don't get a pay rise, how does this affect you? And that's it. So literally that is the financial system at play. You guys are starting to get it. And now next week and the week, subsequent weeks, we're going to look at how to then take this information now and apply it to your investment portfolio and your investment strategy. On that note, we're going to end there and take questions
So if there's anything that you want us to go over again briefly, or any questions that you got on today's topics, guys, just please let us know.
I was going to ask, sorry, in countries where they don't really borrow, like say maybe for example in Nigeria, where a lot of people don't borrow money, then is the system slightly different from what you've explained, like the interest rate, inflation, or is this still exactly the same?
It's still exactly it's still the same in principle, but there are slightly different factors now at play. So in somewhere like Nigeria, it's more to do with how government earns money, revenue, which is predominantly through selling of oil. So if the oil price crashes, the whole country gets into chaos because there's not as much money flowing around because we're so dependent on selling oil. But it still works on the same principle because of the fact that, so for example, in that scenario where the government, when oil price crashes, the government has less money. That means the government now becomes less creditworthy because remember what we said, if you don't have as much income, you're not as creditworthy, you can't get access to credit. In Nigeria, that means the government can no longer borrow at good rates. So that's when you will now see government having to borrow at crazy interest rates like 15%, 16, 17, 18%. And if you actually check the price of bonds right now, that's what the price is or what the interest is on them that you can earn. Because the government is having to pay so much in interest, that means if you do happen to be able to get access to credit in a place like Nigeria, you're going to be paying a lot more because, like we said, government are always seen as the most creditworthy people, then individuals. So if the government is paying 15%, you're going to be paying probably around 25%. And that's why you also now see the reason why there's not as much credit available in a place like Nigeria, or the credit market is not as developed because it really is expensive and it starts at the top. So if the top is getting charged a lot, obviously the people below that are not going to be able to get access to it, even if it is there. I hope that answers your question. Cool, nice. Any other questions? Okay, thank you. So on that note, we'll be ending this session. We'd like to remind you that we're also